This screencast will look at inventory costing methods and its implications on cost of goods sold and ending inventory. There are four inventory costing methods: FIFO, LIFO, weighted average cost, and specific identification. The inventory method chose will determine the recorded value for cost of goods sold and will therefore also determine the recorded value for closing inventory. To understand the four methods, we use the same example for purchase cost in all four methods. The purchase cost of inventory in this example was first purchase at 4 items of $40, second purchase for 1 item at $50, third purchase for 3 items at $60, and the fourth purchase for 2 items at $100, giving a beginning inventory of $590. The first method is FIFO, or first in, first out, and assumes that the earliest inventory purchase is the first to be sold. Therefore, if 4 items were to be sold, cost of goods sold would equal $160 and closing inventory would equal $430. The second method, LIFO, or last in, first out, assumes that the most recent inventory purchased is the first to be sold. Using the same example as above, if 4 items were to be sold, the cost of goods sold would equal $320 and the closing inventory would be $270. This method, however, theoretically assumes that the oldest inventory may never be sold and could remain as inventory for many years, which practically would not happen, and is the reason why the generally accepted accounting principles in Australia does not permit LIFO. However, in certain countries, such as USA, LIFO is still acceptable. The third method is the weighted average cost. This method uses the weighted average cost of purchases as the cost of each good sold. Therefore, using the example above, total cost was $590 and there were 10 products, leaving $59 per product. If 4 items were to be sold, cost of goods sold would equal $236 and closing inventory would equal $354. The fourth method is specific identification. This assumes that every item has a specific barcode or label dependent on its purchase price, and that each item is sold at the price that it was purchased for. In the example, if 4 items were to be sold, it would give a cost of goods sold of $240 and closing inventory of $350. The four inventory costing methods are FIFO, LIFO, weighted average, and specific identification. As can be seen, the inventory costing method chosen will determine the cost of goods sold and ending inventory. Because of this, the use of different inventory costing methods can be seen as creative accounting, as businesses are able to alter their recorded cost of goods sold and ending inventory depending on the method they choose to use.